All right, continuing on with chapter 7. I just realized this a couple weeks too late. Would have been good to buy stock in Zoom if that's a publicly traded company a few weeks ago. All right, so now we're going to talk about, I have a bunch of different gains and losses, and they might even be different kinds of income. How do I net them all together? All right, so this assumes if we have those 1231 gains and losses and unrecaptured 1250 gains, we've already done the 1231 netting process. And so we're ending up with a net, we've either taken a net 1231 loss that's ordinary, or we have a net 1231 gain that now we're lumping in with our other long-term capital gains. All right, and so I'm gonna have different categories, right? I'm going to have my 28%, and I like to do them in order from the highest rate to the lowest among long-term, right? So I have my 28% category, that's collectibles and certain small business stock. My next category is going to be 25%. That's my unrecaptured Section 1250 gains. Then I'm going to have my 0, 15, or 20% gains. Those are my regular long-term capital gains or losses. All right, so this, I'm going to make a thicker line here, right? Because all of this over here is long-term, right? Then over here, I could have short-term capital gains. And right, outside of my capital gains, right, I can have ordinary income and losses. So when I'm netting, my first thing I want to do is if I have gains and losses in the same category, I want to net them together within the column and come up with one number for each. 25% will always only be gains because it's only unrecaptured gains that go here. And a net everything, I'll have one number, right? Then I'm going to start on the long-term side. I always do long-term before short-term. And I'm going to, if I'm going to start from the highest to the lowest, and if I have losses, I'm going to net them moving down so that we're kind of moving downhill. And then I'll move to short-term, and my short-term, if there's any losses here, then they could come back over here, start at the highest, and move down. That's sort of the general logic behind what's happening here. And if after all that, I end up with a net short-term capital loss, these are gains or losses, right? That loss up to 3,000 can offset ordinary income. What else I have? Get rid of my scribbles here. All right, so as we went through, I'm going to net the long-term categories against each other first from the highest rate to the lowest. Right, if I end up with net loss after all that on the long-term side, that long-term loss can go to the short-term and reduce any short-term gains. Then if I have losses within short-term, right, and there's no more long-term gains to net, that loss can go against ordinary income up to 3,000. Anything above that will be a carry forward. If I've already netted all my long-term losses, and now I have short-term loss, right before it goes to ordinary, short-term losses can reduce long-term gains, starting with the highest rate to the lowest. Right, whatever I'm left with in each category, after all that netting, if I'm left with any gains, I'll apply the tax rate for its category to it. All right, so here I made this nice little chart that puts everything in one place. All right, it looks bad. All right, this usually everything's not going to be happening at once. And so, but this captures everything that could happen. But it captures the logic that I net each category against itself. And I'm starting with the long term, then I can go to the short term, right? Short term losses can then go through here, right? You kind of get a sense of the movement of it. Okay. If I've done all my deductions, I've done all my netting. Now I just have all my taxable income and I know the different kinds of income and gains. My ordinary income always goes into the ordinary brackets and I calculate it first. My next step will be if I have any 1250, right, unrecaptured 1250 gains from real estate, I'll do that next. And it depends on how much ordinary income I had. If I only had 8,000 of ordinary income, a 1250 gain that fit here, right, in the other 1,700 that's left will be taxed at 10%. If it fit here, 12. If it fit here, 22. If it here, 24, right? So what that's saying is if the ordinary rate that it would be taxed at is less than 25%, then I can use that lower rate. Beyond that, it's gonna, right, it won't go up to 32 after that. It's can only go up to 25% on those unrecaptured 1250 gains from real estate. All right, so after I've done ordinary income and after I've done any unrecaptured 1250 gains that I was able to fit in here, then I will do collectibles, right? So after ordinary and 1250, if a collectibles gain will fit in one of these ordinary income brackets that's lower than 28%, I'll tax it just at ordinary rates because that's better. All right, but then it's going to be maxed at 28% and it can't be taxed more than that once my income goes above this level. It's pretty simple. It used to be harder before tax reform, so you can count yourself lucky. All right, so if you're doing the tax return project by hand, all right, you can use, this is a worksheet the IRS provides in the instructions. I can't remember if this is instructions to Schedule D or to 1040. All right, but you can go line by line and you should follow step by step. You should end up with the right rates. All right, but it's helpful if you know what you should be doing to confirm that you got to the right number. So let's suppose that Raymond has the following gains and losses. All right, so first, here I only have two different categories, short-term capital gains and long-term capital gains and losses. All right, so the first thing I want to do is I want to net within each category to come up with one number for each category, right? So this is going to be a $5,000 gain, short-term capital gain, and I'm going to have a $9,000 long-term capital loss. Right, so I always start with the long-term. Since I have a loss, there's no other long-term capital gains like collectibles gains or unrecaptured 1250 gains to net against. All right, so I would have done collectibles first, then 1250. So now I can net it against here, right? So now I can go minus 5,000 of this. Now my short-term capital gain is gone, and I only have 4,000 long-term capital loss left, right? Because I used 5,000 of it to net this, right? So we know that now that all of my other capital gains are gone, and I'm just left with one loss. This long-term capital loss can go, right? $3,000 can reduce my ordinary income. That's a terrible line, sorry. And then I still have a $1,000 of the loss left. What I'm going to do, I'm going to carry forward. So next year, when I start I'm going to treat it as if I had a long-term capital loss of $1,000 on top of whatever else happens during the year. And I can carry it forward every year until I have gains or income to offset. All right, so there's, right, in text, you have that in your slides of what we did. Let's take another example of Jane. Her marginal tax rate, we're told, is 35%. She has these different categories of capital gains and losses, right? She also only has two categories. If we add them all up, we can see she should end up with a net positive 7,000. The question is, what's the character of that net gain that she's going to be left with? So I think it's helpful, right, to make, like I said, a little table where I go highest to lowest long term and then short term. So what I want to do is, right, I had a gain and a loss here, and so I want to net them so I just get one number in each category. So now I'm always going to start at the highest on the long-term side, and I have a loss here. Right? If I had a gain, I would just leave it and move on, but I have a loss. So this loss would next move down to the 25% category, but there's nothing here. So I'm going to next move it down to the next highest long-term category. And so I can use $2,000 of that collectibles loss to reduce that long-term capital gain. Right, so I've used 2,000, there's $8,000 left of this 10. Next, right, since I've gone through all the long-term categories, now I can move it down to the short-term. It can reduce that short-term capital gain. Right, these are going to be taxed at a higher rate. That's why they make you do the lower rate ones first. And come here, that brings me down to a $7,000 short-term capital gain. All right, so now I know that $7,000 is short-term capital gain, which means it's going to be taxed at ordinary rates. All right, here's a slightly more complicated example. Now I've got 4 different categories. I have short-term gain and loss, a long-term loss, a collectibles 28% gain and loss, and an unrecaptured 1250 gain. I know they should add up to positive 36,000, but what's the character of that? So, geez, my table really didn't show up here. Let's see what's happening. No, I want this to be first. Actually, I don't want it animated at all. Okay, let's try this. Okay, so I've just taken those from the problem, what it told us, and I've put them in the right column. Now I want to net each column. So, right, I'm going to net here. We're there. All right, so I have a $20,000 net collectibles gain and a $4,000 net short-term capital loss. All right, so I'm always going to go over to the long-term side, and I'm going to start at the highest rate. This is a gain, so I'll just leave it for now, and I'll move here. These are always gains, so I'll leave it. And I don't know, that 0 shouldn't be there yet. My animations are off here. So I'm going to take, now I have a loss. So I have this loss, it's on the long-term side, and I have to use it on the long-term side first. So first I'm going to go back up to the highest category, and I'm going to use this loss here to offset this gain. $20,000, right, of the 40 I can use to bring this down to 0. Next, I'll move to the next highest rate, and the remaining 20 can reduce this unrecaptured 1250 gain, bringing it down from 60 to 40. Now, this will be down to 0. All right, I've used up this loss. And what have I done? I'll say now I can move, right, I've finished all my long-term losses. I can move to the short-term category. Because I have a net loss here, once again, I don't know why this 0 is here yet. I'm going to use this 4,000. First, it would go to the highest long-term category, but that's already 0. So now it'll go to the next highest. that's going to bring me down to 36,000, right? And so now I've used up all my losses. I am 0 in all my categories except I have a $36,000 unrecaptured 1250 gain. It's going to be taxed up to 25%. Since I know the problem told me that Jane's marginal tax rate is 35%, I know this indeed is going to be taxed at 25%, right, max. So she'll owe $9,000 on her gains. All right, so my rules for using carry forwards, right? So I had more than $3,000 of net losses and I couldn't use them all against ordinary income. So it's going to depend on where the net loss came from. All right, so we know that the most in 1 year is $3,000. So what if I end up with a $10,000 collectibles loss and a $10,000 short-term capital loss in 1 year? Well, I'm going to use the short-term capital loss first, right? And in that case, that I would be able to use 3,000 of it. All of the rest of those two categories will carry forward. If my short-term capital loss was 1,000, I would use it up, and then I would go to a 28% loss, and then I would go to a long-term capital loss. If I end up with a short-term capital loss carry forward, it'll start next year in the short-term category. So it'll be treated as if I had a short-term capital loss that occurred that year. If I have a long-term capital loss carry forward, and it doesn't matter which category it came from, as long as it's long-term, it's going to start the next year in the highest category, as if I had a 28% collectibles loss that year. All right, so if I have carry forwards that are long-term and short-term, I'm going to use the short-term ones first when I'm doing my netting process. Some other limitations on capital losses. Right, so we said capital assets are pretty much all assets other than business assets, right? So if I have a collectible or a nice pair of shoes, right, that I just use, are my shoes, and I somehow sell them at a gain, that's taxable, right? If my amount realized is higher than my basis. All right, so capital gains on your personal use stuff is taxable. But if you have a capital loss, which is more likely on your personal use stuff, it's not deductible, right? So it may be unfair. That is what it is. If I have a capital loss, right, we've seen this already to review. If I have a capital loss on a sale to a related person, just like if I have a 1231 loss on the sale to a related person, I can't deduct it. The person I sell to, they might be able to deduct a loss if they sell to an unrelated party in the future, right? And they could use the loss from our transaction to reduce their gain if they have a gain. All right, we have something called a wash sale. These losses are disallowed on sales of stock. I'm going to stop right here. I think all that netting stuff is good to be kind of in one unit by itself.